I don't know how effective you've been building a startup, but the next guy sold his for $35 billion. He co-founded a business called Nextel Communications, which at one stage had 13 billion in sales, 19,000 people. Now he is a San Francisco-based VC, a partner at Lumia Capital. His name is Christopher Rogers, and he is going to lead a very kind of high-caliber team talking about term sheets and how to get the best out of them. Christopher.
سودة مصخمة شبيها حياتي كل شي ما بيها بس هموم ماليها لا تسألني على الدنيا سودة مصخمة شبيها.
I was going to call us up.
I'm trying to figure out the relationship between that music and me, but I'm sure it'll come to me. I kind of liked that last panel. I was sort of like swimming in the nostalgia of it until the post-traumatic stress of having been a PERT 2 user and seen its ability to remove hair very quickly. So that wasn't ideal. And then to top it off, somebody who's sitting there saying, oh my God, I'm old as the hills, and he's 55. Imagine how that makes me feel. Anyway, I'm not going to introduce individually all of the panelists, but we have Jim and Danny and Michael, and I think you know two of them. Jim is the one you care about, number one, because he's a sponsor. So we have to give him the first word and the last word and the loudest applause. Jim Morrone is an attorney from San Francisco, Latham and Watkins, big-time firm, and he's a big-time attorney. So let's welcome him. And Michael and Danny, I mean, come on, just come up.
Hello again.
Hey, how are you? So I understand, Danny and I have an interesting relationship. And
no.
It's, I'm not going to go there.
Yeah, thank you.
Because I understand your father's in the audience.
Exactly.
So I get it. That's off limits. That takes about half this panel away, which is too bad. Now, a couple things. One, I see one person already yawning. Amir, thank you. But there are all these beanbags up here. So for many of you, this is going to be an excellent napping opportunity. I'd just come up and use them. Move on up. And second, this is supposed to be sort of an entrepreneurial group. And for an entrepreneurial group, I say this at every panel I do, there's a remarkable lack of smartphones in your faces. And coming from the mobile business, I love to see smartphones engaged. And if you're a founder or an entrepreneur, it isn't possible that this is the most important thing you have to do this afternoon. So at least multitask during this panel and put these smartphones up and start working. If nothing else, you can, record the incredibly insightful answers that we're going to get here. Okay, I'm going to start off on the super boring but sort of useful, which is a little bit of the trend in the earliest stages of financing that those of us from Silicon Valley have sort of watched, and I think the local investors have seen as well. So I thought I would get you to just maybe walk through just a couple of key basics between the sort of convertible note into the safe format, and whether there's anything that is brewing that we ought to be looking out for in the deals here.
Sure. And when we sponsored this, we were hoping that you would start with a boring topic and get me started. So
No, but you're going to finish with the exciting stuff.
Safes came out about 2013, I think, from Y Combinator, and really took off pretty quickly as a vehicle for people to use. They have been adapted a few times over the years, and just recently, in the last month or two, they've come out with a new form of safe. When it first started, it really was nothing different than a convertible note that didn't have a maturity date on it, and it was a way of avoiding this being debt. It was instead an equity instrument that really accomplished exactly the same thing. Really solving more of a theoretical problem in the US that people didn't want to have a company that wasn't successful, didn't raise money, and then what do we do with this debt outstanding? The answer in the US is nothing. You just put the company to bed and move on. But that could be useful in other jurisdictions here as well, where maybe there's an aversion to debt and you want to have an equity instrument. And that's been basically the genesis of it, and most people have adopted it just because because Y Combinator, first of all, has a lot of companies, and they make sure that all of their companies are on this instrument. They have become a market leader in that, and it's very easy for people to just say, let's use a form of SAFE, and everyone knows what that is, and there isn't a lot of negotiation that has to occur. I think that's one of the things that's a little bit different here in terms of a shared understanding of basic standard terms that people are willing to accept. So there is less negotiation on the front end, and you can get to the business of making your investment and building product.
Well, actually, that's I did want to follow up. So you all know Michael because of Property Finder, but he also is an active early stage investor. And so in that, I'm not sure how involved you are in the term sheet portion, but are you seeing the adoption of a particular early stage term sheet format?
You mean here in the Middle East
Yeah,
compared
here.
to Silicon Valley?
Yeah, here.
Obviously, people will look at what's working in the Valley or in the US and try to bring it over. But it tends to be a little bit less aggressive, I feel, here, to be honest. It's quickly catching up, though. But from what I've seen and when I've dealt with American investors, they tend to be a little bit more aggressive.
Okay. Well, that's a whole nother topic we'll get to. How about you, Danny, in terms of the early stage?
So what I'm about to say sounds like I'm plugging Latham and Watkins, but I am for good reason. And
So we need to sponsor next year?
Yeah. It was written in the contract.
No.
You only got probation.
It's
as I
unfortunate that
understand
you had to make that earlier intro. But anyway, so we've been working with a lot of law firms here in the region. We've had great support. But I have to say that when we started working with Latham's at the beginning of this year, we actually, so let's do this. Who's actually done a subsequent round to a prior round with just marking up the prior documentation? So Series A to Series B or whatever, late seed to A, without redrafting documentation. Hands up. So very few hands up, right? Yeah, I mean, so that's exactly the way you guys do it. For me, it was like, what? Wow, you just blackline the prior documentation and it saves months of heartache. Of course, assuming that there's a benchmark and a basis of which you can actually build off of. But that in and of itself, for us, was a breath of fresh air, let alone the safe notes. So we're actually doing 5 investments right now. 2 of those are safe notes, but they are the earlier stage ones. So 2 out of 2, to be honest with you.
Okay. The topic here, under the good, the bad, and the ugly. And I'm looking at the 3 of you, so I'm pretty sure where the ugly fits, which is disappointing also. I'm just not sure where the good and the bad fit. But when we look for the worst term sheet stories, let's go to some horror stories if we can. And again, I'll go to our sponsor to start.
I would say, the horror stories really are when there are obvious terms.
I don't want generalities. I want specifics.
Well,
how bad it was, who did it to whom.
Names. Throw it out there.
For
Come on.
sure, dates.
I can't reveal names.
Initials.
I can't say. Just this year, we were brought in on an M&A deal, post initial draft of the term sheet, before it was signed. And in the interest of expediency, we're specifically told we're not going to mark up the term sheet. We're going to sign it, and we'll sort it out later. To me, that is the biggest disaster because in this particular case, there were lots of material issues that we knew were not agreed on and that were open. And my preference is always, there's certain times, very limited, where that makes strategic sense to maybe wait on one issue or 2, but not if you know that there's a material issue, the term sheet is the stage to get it out, because you can pass back and forth a 3-page, 4-page document much easier than once you get into drafting definitive documents that might be 100 pages. Is not the time to be negotiating key issues. So the disaster is, in my opinion, is when you punt issues that you know are material issues that should be raised at that stage. Now, in the U.S., especially for early stage investing and venture investing, the term sheet has now shrunk in many cases to the short form term sheet that's 1 page long. And you're really putting in one line, valuation, option pool, protective provisions, and everything else is kind of standard. And everyone knows what that means. And so that doesn't really lead to problems because there's become such a standard of what market terms are. I would say here, you're probably not at a stage where the 1-page term sheet's going to get you there. So the importance, I think, would be, creating more detail up the early stage to prevent, misunderstandings later.
But we have seen term sheets. I mean, we ourselves, maybe 7 years ago when we first started out in this journey, we had 10-page term sheets. And I think the reason we did that... You remember?
That
was painful.
Was that the short version?
That was the short version.
Yeah.
Yeah. But here's the thing. So I think we were all new to this, to be very honest. And there really wasn't much in the way of precedent here. I know that, it's the age of the internet. We could have probably gone online. And we did, actually. Brad Feld had written that Venture Deals book. We sort of read that 1,000 times and used a lot of the wisdom that came out of that book. But I guess we ourselves wanted to do two things. Lack of precedent, so you sort of don't know where this is going to go. And I think a lot of the entrepreneurs that we were talking to didn't understand the terms. I remember, actually, in the early days, we'd literally sit them down and say, right, it's a 2-hour session. This is what this term means. And, literally spending 5 minutes per term on a 10-page term sheet. But yeah, I mean, we're not quite to 1 page right now, but I would probably say we're down to 2.
Yeah.
Michael, did you have any bad experiences in there?
Be honest.
No, luckily it hasn't been too bad. But if I think back at the days, the term sheets, or even the deal that we signed, we've pulled it up recently, right? And obviously it was Danny's first investment, or one of his first, was it the first? Yeah?
Second, maybe.
Second investment, and it was in 2012. So I think everyone was a little bit scared, and there was a lot of protections, right, in there, which today would never fly, by the way. Luckily, the business did well, and we never had to kind of enforce them. But if, there was pretty rough terms in there, and it ended out well for everyone. So we're all happy.
But I will say this, is if you develop a strong relationship based on trust both ways, that you can have conversations around them. I think, the day that you're opening up the drawer and pulling out that contract to look at it, you have issues.
Yeah, but the thing is, an investor has a duty to his LPs.
Sure.
So no matter if he thinks that, it's not really fair, but that's what the term sheet says, he's legally bound to enforce it, right? Because he's, at the end of the day, investing not his money, but his LP's money, right? So even if he likes it, he's like, look, it's not really fair, and I know that's not what really we agreed, but the term sheet says that, so I have to apply it. Otherwise, you are at risk. And sometimes I think this is where there's a little bit the disconnect between the investor and the entrepreneur, is that we think that we have kind of, always that trust, but at the end of the day, the investor is responsible for investing his LP's money.
But I'll give you an example. So we were at a time in 2012 where I would say, I don't know what percentage, but we saw a lot of term sheets going around, and actual derivative documentation, not just term sheets, with full ratchet mechanisms in there on the liquidation preference. It's like, really? Anti-dilution. Pretty, onerous stuff.
This is what we want to hear about, the onerous stuff.
Yeah.
Who tried to do that?
Participating.
You want names?
Of course.
In fairness,
they want names.
In fairness, that is in 1% of all deals.
That's in 1%. Yeah. So by the way, Wilson Sonsini have this term sheet generator that when, as you go through and use it, it not just gives you the definitions of the terms, but it actually gives you the statistics that the firm globally sees. And I think at the time we were looking at it, and it was like 10% to maybe 8% of transactions had full ratchet at the time. I think, but it wasn't 1%. But anyway, I mean, we were appalled by that term, and we've never had that in any of our term sheets. But I tell you something, the industry here, a lot of people were, that was like the standard.
I've had real world experience with an investor who had a full ratchet and insisted on enforcing it, perhaps for the reasons that you stated, that he felt like it was necessary to do so. And this was in 2001, after the market crash in the U.S. And it was hurting the valuation on the future round, and the valuation was already low to begin with, just because of the market. And by the time you run through the numbers on the full ratchet, it basically shoves everyone down, and then the other preferred stockholders get pushed back up through their anti-dilution, and it really just hurts the common stockholders. And in the United States, that's basically management.
Founders.
And at the end of the day, in order to keep management incentivized, you turn right around and you re-up the option pool and you grant them options. All you've done is turn their equity into a less efficient and less tax efficient means of compensating them, and no one actually benefited. And so I think that's the reason you don't really see that term.
There's something that's really cool actually about this discussion. I'll tell you what this is I was actually exiting one of my prior businesses, and I was on the other end of Latham's, now that you speak of it. And actually, I remember you and I, when we were going through the term sheet, when we talked about why some terms were in there, my response was, dude, I just signed a transaction that Latham's represented the buyer, and I was the seller. And you know what? I signed to all of this and some. And that was a much later stage private equity transaction. It wasn't even a venture transaction, which is like going into the black hole. So,
Chris, sorry, I'm going to chime in here for a second. You mind?
I thought you were
Not
sleeping.
the format. No, I'm very wide awake, especially when Danny speaks. So
That makes one of us.
one thing.
Boo.
Sorry, I wanted to just explain when we first saw Property Finder. I mean, it was our first deal. It was a pretty sizable valuation relative. So we had to really.
Oh man,
the stage the ecosystem was at.
2000.
It was like at that time we never saw deals that size, right?
You can say it.
we had to stick terms in that we would normally not do today. So
Yeah.
I'm just trying to.
I like how
Add
they're
to
on the
it.
defensive, huh?
Really?
No.
But let's
I-
go to that. Are you finished? No, there's more. That's fine. No, good. All right, good night. So the common storyline here and in other emerging markets that we see is at the earliest stages, seed, angel stage, founders had been historically giving up huge percentages of the company, which is a perfectly fine decision if they're not going to raise additional capital. But then when you're trying to access a more traditional venture structure, your cap table just doesn't work. Are you still seeing that in this region?
I think the short answer is no. If you wind back the clock, you didn't have any angel groups to lean on, right, for collective wisdom. And so people were just doing all sorts of crazy things, and there wasn't the ecosystem there is today. Without naming names, oh well, you know what, I'm going to name. So I think Jordan had, in the mid-2000s, was a very successful and vibrant, up-and-coming tech ecosystem, and I'm not going to lay it on one factor, but I think one of the big factors that actually scuttled Jordan's progress then, and obviously Dubai and other parts of the world took to pick up the slack, was the fact that there was a few accelerators and incubators that were taking a significant equity stake. Forget what they were providing them with for a very, very small amount of capital. You're talking 30%, at the get-go for an incubating for incubation, which is just preposterous. And so, they just couldn't make it to subsequent rounds because of that. So they just set the entire industry in that country they challenged it. So. You wanted
Okay.
names? You got it.
Okay. How about Egypt? Want to throw them under the bus?
No,
Even if it's a swivel?
no, I don't think. No, I think you're talking about a collective industry, right?
Well, I don't know. I mean, there are some differences in the groups and a little bit difference in the sort of stage by country in the broader MENA region.
Yeah. Someone, I can't remember who it was, one of the big VCs in the US just recently tweeted something to the effect of super pro rata should be outlawed. Oh, it was Fred Destin, actually, and he's here tomorrow. He may even be in the room. Fred, are you here? From Stride VC, ex-Axel? No. I think that's what you're alluding to, Chris.
So let's talk about, though, a little bit of the geographic differences. Not necessarily because of a difference in the outlook of the venture capitalist or investor, nor of the entrepreneur, but simply because there still remain some structural, legal differences in the GCC and MENA broadly. What are the ones that you think really screw up deals, are still problems? Is it, you need to be a SAGIA entity or whatever it is? What are the ones that you think people need to know about?
You want me to answer this?
Well, I will start with you and move this way.
I think for every problem...
Let's not put Jim on the spot for that
every problem,
yet.
there's been a solution, right? If it's, everyone's...
But they want to know what the problems and solutions are.
So, I mean, the problems could be being onshore, having to be 5149. Most GCC countries now have free zones, so you sort of circumvent that. But most investors, institutional investors, certainly from outside of here, won't want to invest in a TCOM FZE, nor a JAFZA business company because they just don't understand it. And so it's got to be BVI, Cayman, whatever jurisdiction that you then have England and Wales law or New York law, and you have a proper jurisdiction. I think the cool thing that happened here, and again this is part of the solution of the problem, is that Dubai proper actually, Sheikh Mohammed actually changed the law a few years ago such that you could use DIFC courts as your jurisdiction even on local companies, which was just genius, right? Just to circumvent the current state of affairs in the local Dubai proper court system. I'm not helping you out here. I know.
No, it's okay.
So there are lots of issues, but again, we've always been able to circumvent them. Even sort of IP, trademark, and registration that was talked about earlier. You do these things locally, you do these things globally. It's a pain. It takes 18 months to actually get a word back from the IP trademark office that, hey, yeah, we've got your registration. It's a joke. But it is what it is, and we just get on with it. It hasn't really been a hurdle.
Michael, you've taken money from funds outside the region too. Did anything crop up that took extra time?
No, I think you have to do things right from the get-go, from the beginning, and get good legal advice. But ultimately, no, we rolled up our FZ LLC to a BVI, and the investors invested into the BVI, right? So you can do that with BVI of Cayman, and then whatever's under, as long as it makes sense. They even accept the Mudaraba agreements, right? Where you obviously have a local sponsor that owns 51%, but you have an agreement. So global investors are okay with that as long as you've got one of the global audits, right? One of the big fours that says you actually control the asset, even if you don't have 51% on paper, you're the controlling shareholder of the asset, and therefore you can consolidate all the revenues.
I think it might be a little bit of an overstatement to say global investors accept that. I think you found a group that do, and it's not, but I don't think it's 100% uniform yet, because you're still teaching some of them some of this.
So Tiger invested in the business I was involved in before in I think 2005, 2006, Bait.com. And I remember when all the legals were done, we had these reps and warranties and disclosures and covenants and God knows what, and they were like this thick. And they actually looked at them, and we looked at them, and they said, what's this? And we were disclosing things like, in Qatar, we have a 51% arrangement because even a GCC national has to have a 51% Qatari, certainly in those days. I don't know if it's changed now. I don't think it has. And to explain that to somebody from the States was, but what was cool about them was the minute they got that that's the way things were done in this part of the world, there was no obstacle. They got it. They understood the risk. I think, again, trust. And we did the transaction. But sorry, just back on your thing. So we actually signed a term sheet in September of 2012 with Michael. And I think we funded it like Q1 of 2013. And say March. You're talking about 6 months. You know what what we spent the 6 months on? Taking the FZE, rolling up to the BVI, and doing all the legal structuring.
So Jim, on that front, from a U.S. perspective and a U.S. funds that invest just in the U.S. globally, but also have LPs around the world, Is there any trend between, say, Cayman, BVI, Luxembourg, plain old Delaware Corp that is, you see people moving to either one has become less convenient or one is really put in place super easy platforms to do business?
Well, in the U.S. for a long time, the Delaware C Corp has been pretty much by far and away the most popular vehicle, in part because of the way the funds are structured and avoiding taxation up to the LP level. There's been a lot more, I'd say, in the past 5 to 10 years, comfort and flexibility to invest in pass-through entities. And so that is a bit of a trend. I think.
Do you maybe give a couple seconds about what a pass-through entity is, just for the audience here?
Just in the U.S. at least, a pass-through entity is an entity that's disregarded for federal tax purposes. So the income of the entity becomes the income of the investors, which is a pain. It's administratively more of a hassle. You've got to report up the chain, and each person has to make their own tax filing. So that's what people have tried to avoid for a long time. But entrepreneurs and companies have really wanted to stick with that because there are a lot of advantages to that structure beyond the taxation that people have wanted to stick to, and so investors have sort of been pushed by the market to start accepting that, and have gotten comfortable with doing that and just dealing with the administrative hassle. But again, it's similar to what you were talking about. I think all of this is. People can change, but getting to a standard set of terms is really about just having a common understanding, and sometimes it takes education, and sometimes that takes time.
Right, okay. Maybe I wanted to go back and forth a little bit rather than wait till the end for audience questions. So if somebody has anything that's relevant, I would go ahead and raise your hand and let them get you a microphone. And while they're doing that, if you get to him, I'm going to do one more question up here. Can you guys, I don't know if, Michael, if you've done any of these, but you've certainly seen the ideas, and everybody knows my namesake, Patrick Rogers, who's building some platforms here, and I think you even met him.
Yeah.
Can you guys give a little of the pros and cons of, traditional legal services, even if they're, who are very focused on a specific area, which builds efficiencies, versus some of the more automated platforms, outsourced, offshore, those type of things, which can be, basically you get online and you have a term sheet, you have corporate docs, you have things like that.
Well, I think that's definitely a trend, and I did talk to Patrick, and I think what he's doing is fantastic. It was you might be able to better describe, but it was part giving entrepreneurs a score based on their level of education on certain terms and documents. So as an investor, you come in and maybe there's already a base level of education, so you're not having to start from scratch, which sounds like a great idea. We in the U.S. have for a while now used these platforms as well. What we want to do is automate the routine, get the routine sort of frequently asked questions out there for people to be able to review on their own, so that we're dealing with the more high-value questions, the more high-value advice, because people don't really want to pay lawyers for the routine, and we don't really want to be doing the mundane as much as the high-value work. So we have formation documents that are automatically generated. We have term sheets. You mentioned the Wilson. Everybody has those platforms where you have these basic documents and basic information about terms, market that's automated, and it just I think facilitates the entire ecosystem.
Well, go ahead. Why don't we it's your chance for free legal advice, so you should go for it.
Can you, thank you very much for speaking to us today. Right here.
Oh, yeah.
Can you guys shed some light on some examples of disputes that were happening between investors and entrepreneurs in the region with the regulatory framework we have here? I want to know some cases on disputes and sort of dispute resolution here, and how you guys have approached that subject. And
Are you expecting one soon, or?
You never know.
Okay.
Thankfully, we can't help you.
I think there's a will between investors and founders to not bring it to disputes, right? I think it's really bad for an investor to drag an entrepreneur or a founder into court or whatever it is, and if he wants to invest, he wants to make sure that the entrepreneurship community continues to view him as a good investor. So I think it get resolves earlier. I don't know if you, as a law firm, have seen a lot of disputes, but thankfully, I've never also been exposed to that.
Yeah, I think hopefully disputes are rare. It's not in anyone's best interest. It's not in the company's best interest to have. Obviously, there are high-profile issues like with what happened at Uber that can come up from time to time where they're. It's probably more in some of those cases pushed to the point of there being a necessity to make a change, and even then it was handled relatively outside of the courts because everyone understood that it's in the best interest of the company to try to avoid that. So if you've gotten to the point where you have a dispute. And if you haven't reached a level of maturity, you may not be able to survive that.
Did that help your situation at all?
Try to work it out.
Try to work it out. Okay, thanks.
Speaking of Uber, the key funding source of Uber has been PIF. We know that there were some, what I would call sort of knee-jerk reactions in the Valley about sources of capital that would even start at the LP level, flow through a GP into a venture fund. Do you have any sense of whether that's going to amount to anything? Have you seen anybody asking about it at the LP level?
I don't deal too much with the LP side, but the talk that I've heard is that it hasn't really had an impact at this point, and I'm not sure that it would. My sense is that money is capital is capital, and that this is going to blow over without there being any real long-term ramifications.
So,
how about you guys? Have you seen any impact here?
well, before we get to impact, so Fred Wilson from USV wrote a blog. He's a prolific blogger. We follow him, and we learn a ton from him, and we really enjoy the fact that he's as transparent and candid with how he thinks and what he does. He's even posted his financial model, the sort of portfolio construction, which is just awesome. But he wrote a blog 10 days ago, I think, basically saying he's been asked by his CEOs, his founders, who are his LPs, because they wanted to make sure that there was no blood money. And somehow in the conversation, there was a reference to Gulf money, and that he had sold his Twitter stake to Gulf investors, and so he was somewhat tainted. And then our very own Amir Farha, on a flight back from San Francisco, unable to be at peace with that blog because it was written in a manner that essentially could be construed to be tainting people from the Gulf. And so on a 16-hour flight back from San Francisco, as one does, unaccompanied, as one does, one has a lot of time to think and write, and he wrote a beautiful response that actually went out on social media, and it was I think an elegant response.
That's the whole reason I brought it up. I thought it was beautifully written, and that's why I called the reaction knee-jerk.
Thank you. And we got a lot of support from a lot of folks in the US, in Southeast Asia, Patrick Grove, a whole bunch of folks that we talked to from Europe saying, well done, kudos. And actually, to be fair, Fred himself initially tweeted and said, look, I read it again a few times, I don't get it. And then came back again with a classy response saying, very humble response saying, yeah, okay, sorry, thank you, I appreciate your guidance. And so yeah, there's definitely something going on. But I think
Where can we read the response? It's on Amir's tweet?
it's definitely on his tweet. It's on our
It was
blowdown.
LinkedIn. It was in a lot of places.
We'll send it to you. It was a nice piece of poetry. We're very proud of it. By the way, just so you know, so I think what again evoked the emotion in Emir and all of us, but he had the guts to actually write it and post it, was that, we have, I don't know, 10 LPs in Fund 1, Fund 2, apologies, maybe 20, more friends and family, Fund 1. And these are some of the most incredible Gulf families. You know them all. Chris, you know a lot of them too. And so we felt it was, it was a inappropriate dig that we needed to fix. These are good people. And by the way, even PIF, we're not politicians, we're business people. It is the people's money. It is the Saudi people's money. So
Yes, well, as you know, I'm involved with some of their companies.
Yeah.
But it's a related issue, so I'll let you jump in. But and this is where
We have questions.
maybe you want to close your ears, Danny's dad, because it sometimes you're seeing, because of certain movements in the U.S., the morals and ethics clauses. I'm joking, by the way, about that, of course. But have you seen them filtering into the relationship between funds and founders, where people are predicting that there may be bad things that get in the press or do other things in this era of heightened scrutiny?
Yeah, I think we're seeing, not necessarily on the issue we were talking about, and one thing I wanted to just say on that is that it may be that people are asking the questions. There's really nothing they can do about it in the short term. There's no mechanism in most of these companies for kicking an investor out.
Just the media blowing up.
And I think that the public's memory on these things is pretty short, and so it may be a short-term flare and a bit of a PR, but I'm not sure over the long term, it would lead to anything. You're certainly seeing on, the Me Too movement, the Me Too clauses that people are putting in, and I've personally been.
You don't need to tell us.
You stopped me at just the right time.
I know you're jet lagged. I
thought we
get you in a vulnerable
we were
moment.
being open and transparent.
Not with this group. No.
No, I've been involved.
You're already on 3 blogs, I can promise you.
I've been involved in representing investors who had issues in prior companies within this past year and a half, and so I've been very focused on this as a diligence issue, and having some ability to do something about it.
So is there something that either the founders or the funders should sort of take as what the best practices will be? Just sort of expect them to be coming our way soon in this region?
I think there's just more focus on an ability to make a change for breach of company policies with respect to anti-harassment and these types of issues. So that was not something that was in papers 2 years ago and is now finding its way in almost all of these.
Okay, so let's go back to a couple more questions. I see one there.
You mentioned several jurisdictions with regards to offshore entities, Luxembourg, BVI, etc., and yet we're beginning to see the emergence of some regional ones. What are the investors' perceptions of regional hubs that are beginning to act as offshore jurisdictions for fundraising? And what's the perception from the US, if you were to do follow-on rounds in the future, of those type of jurisdictions? So one from regional investors' perspective.
So do you mean like ADGM,
for instance,
that type of thing?
Exactly.
Let you guys
Look,
start.
we've actually looked at quite a few companies that are all ADGM licensed. We're happy to invest in it and have done. I know a few. So it works. We're just used to a certain structure that we can replicate very, very quickly. So it's just far more efficient for us from a structuring perspective. But I think kudos, ADGM has done a phenomenal job of being a BVI for everyone else here, but also working with the local authorities, the banks, to get you, because the most difficult thing if you're a BVI company is actually getting a bank account here, right? ADGM has solved that. But again, it's quite new. I think it's earlier this year they started all that. So so far it looks, very encouraging. We would probably still always go back up to BVI at some stage and pierce through. And that is not because of our preference. That is because if we are going to attract capital from outside, from the Valley or wherever it comes from China, they understand those jurisdictions and the legal jurisdictions and far better than they would in ADGM.
Yeah, as an entrepreneur, you have so many things to justify about your business to an investor. The last thing you want to do is to try to justify the jurisdiction you're in, right? And have to kind of sell the jurisdiction. So sticking to BVI or Cayman for the global or for the holding level is definitely recommended if you're going to be looking for international capital.
I mean, we're a Cayman fund, and the second one, the first one was BVI. The problem with that is that you've got this US-Europe battle going on, right? Where the Europeans say can't touch anything not European, certainly not Cayman, because that's where the Americans are, and other similar jurisdictions. And so it's now, I mean, it's a little bit like what goes on here, where the solution is, okay, how about this? How about I'll do a parallel fund for the third time? You're investing in the same fund, but the parallel fund will have Amsterdam, language and jurisdiction. Yep, done, we can do that, no problem, as long as it flows up to a European entity. So I guess the answer is, we'll figure out ways around all of these obstacles. There are always solutions.
Does that explode?
Looks like there's a question over here.
Thank you so much, guys, for the great event and inviting us. It's amazing. My name is Yusuf. I co-founded a company called Solar Technologies. It's a last mile and express delivery electrification platform. So we're just closing now our pre-seed. It's a very tiny amount of fund. It's just $300,000. Now the question is, we have some terms at that stage that I think personally are not very favorable for us. But we cannot afford having a legal firm to have a look at them and etc. So my question is, at the other series, like from an investor perspective like yourself, how do you look at all terms that we signed? Do you need to look at terms that we signed at pre-seed stage and use these as a leverage from your side when we want to raise Series A, let's say, or seed stage?
Where are you based?
Masdar.
Masdar. And you're incorporated where? Here, onshore?
It's a free zone.
It's a free zone. You're incorporated in Masdar?
Yes.
Look, I think it can go either way. So depending on how bad the foundations are, you could mark up that documentation, and you could find firms that just really know what they're doing, and they could do it quite quickly and painlessly and cost effectively. And if it's just, it's like building a building. If you're trying to redo a building that's just structurally often going to collapse, you're probably better off. And in some cases, that's why working with Latham's was actually a breath of fresh air, because what we would do in the past, every single transaction we've done, we had 23 investments, we would redo legals from scratch at every single round. That's tiring. Yeah, exactly. Mm-hmm. But I mean, that was the precedent that was set in the marketplace. So we're glad that we can raise the bar in the region. Did I answer your question? I guess it just depends on how good or bad your...
Well, it depends also on the specific terms. Some are much more relevant to follow-on investors than others.
So, by the way, the famous term, which is set the valuation and I'll set the terms, right? So if the valuation is too high, then these funny terms start creeping in. Funny. Then a lot of these terms, in some cases, if the valuation feels really outlandish, are, I think from an investor's perspective, obviously, pretty okay.
But usually what you give in the early days, you can't get it back later.
Yeah.
That's a rule of thumb.
Unless you become like the next Facebook.
Yeah.
Right.
I mean, whatever you give in, the next investor will come and look at your terms and say, but you agreed to that to the other investors, so why aren't you giving it to me?
Yeah.
And anyway, they don't want to be in a worse case than your previous investor, so they'll ask exactly the same terms. So you have to give in the least possible.
By the way,
in the earlier days.
That's the best negotiating tactic from an entrepreneur, but it's true. We even say we don't want to put all these onerous terms in, not just because some of them we just don't like and we just won't subscribe to because they just don't feel fair, but also you set the wrong precedent too early on. It just, can you imagine 4 rounds down the line, it just becomes, layer over layer over layer, it just becomes pretty ugly. But I will say one thing. We actually had an exit, I think last year, And we did not have a liquidation preference clause in there because it was not Sharia, or at least that's what we were told. And we still did the deal. And it was a very light, watered down side agreement Sharia liquidation preference. And when we had the exit, the founder, again, this just comes down to trust. We didn't ask for it. The founder felt that because the valuation was so much higher than it should have been, actually came back and gave us the proceeds as though we had a liquidation preference. So we basically made half our money back on something that we should have, walked away naked. So there are good stories.
Well, since we're way over time, maybe we should end on that positive note.
Yes.
So thank you very much for the insights.
Thank you, Chris.
Thank you, Christopher, Danny, Michael, Jim.